Okay, today we see the exercise number 27. In the exercise number 27, importance is there is admission of the another person in the firm. Okay, so Santosh maintains his books under single entry system. His position on 31st March 1996. 31st March 1996 is given below. 31st March 1996 is given below. That is the year and date, land and building, land and building, debtors, stock, bills receivable, cash at bank, sundry creditors, bills payable, expense due. Okay. This is on 31st March 1996. Whether it is a opening balance or closing balance, you have to know first. You come to the decision regarding opening balance or closing balance. Is it opening or closing? So they admit Vikram on 1/4/1996. After this date, this is 31st March 96. This is 1/4/96. Therefore, it is after the date. Okay. Then next is you see the additional cash book date. Cash book date is 31st March 97. So whatever given in the starting, that is the opening balance, because 96 here is there, here 97 is there. Therefore, that is the opening balance. And these are the information. In the first, they have given the opening balances and admission of a new person. Then cash book is here, additional information is here. Okay, we will see one by one. This is the problem. So this is clear that it is opening balance. 31st March 96 is the opening balance. This is the last day of the previous year. Last day of the previous year will become the opening balance for the current year. Remember this. So land and building 50,000 goes to asset side of the opening statement of affairs. Debtors goes to opening statement of affairs and opening balance to the debtors account. Stock goes to opening statement of affairs and the stock goes to opening statement of affairs and the trading account. This goes to trading account. Bills receivable, statement of affairs, then opening balance of bills receivable. Cash at bank, opening statement of affairs, then it goes to cash book opening balance. Sundry debtors, sundry creditor. Sundry creditor goes to opening statement of affairs, then you take as opening balance in the creditor account. Bills payable, statement of affairs first, then take in the bills payable account, opening balance. Okay. Then expenses due. Expenses due, first you take in the opening statement of affairs as outstanding expense, liability side. Then this is to be deducted in the expense P&L account. In the P&L account, you deduct in the expense. This is the last year outstanding. This is last year outstanding, therefore it is deducted. Current year outstanding, you have to add. Okay. Then come to the next. He admitted Vikram on 1/4/96. 1/4/96 is the opening date, by giving him 1/3 share in the future profit, on the condition that he should bring 40,000 as capital. Okay, he is to bring 40,000 capital. This capital you have to record in the cash book debit side as Vikram capital. This is to be recorded, 40,000 is to be recorded as to Vikram capital in the cash book. Okay, then you have to take in the balance sheet liability side. Okay, and his share of profit is 1/3. Share of profit is 1/3. If there is a profit at the end of the year, if there is a profit at the end of the year, in the profit you give 1/3 share to Vikram and 2/3 to the Santosh, existing person. Okay, you have to share the profit between Santosh and Vikram. Okay, you give 1/3 to Vikram and remaining 2/3 to Santosh. Okay, this is the point you remember. Then the new for maintained cash book with bank column, the summary of which is given below. All the transactions are recorded in the bank column. Okay. Now you see the bank account. This is the bank account. This is the bank account opening balance taken from the opening statement of phase. You take the opening statement, it goes to opening statement of phase. Vikram capital goes to balance sheet. Then debtors goes to debtors account by cash or bank. Bills receivable goes to bills receivable account by cash. Cash sale goes to cash account. Sorry, trading account, credit side, 15,000. Bank overdraft, year end is there. This bank overdraft is the liability, goes to balance sheet. Closing balance, this bank overdraft is the closing balance of this account. Opening balance is debit side, closing balance is also debit side. Opening balance is the balance at bank, closing balance is the overdraft. Okay, this is the closing balance you have to take on the liability side of the balance sheet. Remember this. Okay, sundry creditor goes to creditors account to cash. Bills payable goes to bills payable account to cash. Wages goes to trading account to wages. Salary goes to P&L account to salary. General expense goes to P&L account to general expense. Furniture goes to balance sheet. You have to take this in the balance sheet. And date is given 1/7. On the basis of this 1/7, you have to depreciate or make the adjustment. Drawing, adjust in the capital, less drawing in the capital. Santosh drawing is to be deducted from the Santosh capital. Vikram drawing is to be deducted from the Vikram capital. This is the point. Then come to the additional information. Closing balances are here. Closing balances are here. So closing debtor goes to debtors account by balance carried down. Sundry creditor goes to creditors account to balance carried down. Bills receivable goes to bills receivable account by balance carried down. Bills payable goes to bills payable account to balance carried down. Closing stock goes to trading account by stock. Okay. At the same time, these all items comes to balance sheet. All these items comes to balance sheet. Remember this. Then bad debt. Bad debt is to be deducted, or you take the debtors account debit side. Sorry, debtors account credit side. Bad debt, debtors account, the credit side by bad debt, and P&L account debit side. Discount allowed, debtors account credit side by discount, P&L account debit side. Sales return, debtors account credit side by sales return. Okay. Then it is deducted in the total sales in the trading account. In the trading account, you have to deduct this. Remember this. Okay. Then depreciation, furniture 10%, P&L account. Then deduct in the balance sheet. No expenses due at the end of the year. Expenses are not there. Expenses are not there means So there is no outstanding expense. Only you deduct the last year outstanding. Okay, prepare necessary accounts. You see the accounts. First, I will prepare the opening statement of office. Opening statement of office I will prepare. Date is 31st March 96. Opening statement of office. It is the last year end date. You may change as 1496. You may write as 1496. As per the given problem, I taken the date. You may change it. 1496 the opening date. You may write 1496. No problem. Then this is the statement of face. I'll write the balances. First balance is land and building. First opening balance is land and building in the problem. Land and building 50,000. First, I started from the beginning in the problem. Okay, you take the problem and start from the first. Then second item is debtors. Sundry debtors is 50,000. Third item is stock, 30,000. Fourth item is bills receivable, 20,000. Next is cash at bank, 10,000. Then sundry creditors, liability side, 40,000. Bills payable, 15,000. Expense due, 5,000. Okay, I recorded the transaction serially. Okay, in this way you record the transaction. These are the opening balances. Then they admit the a new person Vikram on 1496 by giving him 1/3 share of the profit, and cash book is there. So these are the only balances regarding the opening statement of office. Now I'll prepare the debtors account, bills receivable account. Next, prepare debtors account, bills receivable account. Okay. Again, I start from the first. In the starting, opening balance is there. Debtors. Two balance brought down 50,000. Next is in the balance, bills receivable is there. Two balance brought down 20,000. Okay. Then you go to the cash book. Second part, cash book. In the cash book, sundry debtors is 90,000. Debit side. Sundry debtors 90,000 debit side. You record as by bank. By bank 90,000. And in the cash book, debit side, bills receivable 25,000. You record as by bank in the bills receivable 25,000. Okay, this is the bank account completed. Come to the adjustments. In the adjustment, closing balance is there. Buy balance carried down, debtors is 30,000. Then buy bills receivable account. Bills receivable closing balance is 15,000. Okay, 15,000. These are the balances. First point. In the second point, bad debt is there. Buy bad debt 2,000. Next, buy discount 3,000. Buy sales return 5,000. Depreciation goes to P&L account. Expense adjustment goes to P&L account. These are the items in the debt related with debtors account. Okay, debtors and creditors items recorded serially. Then go to next, creditors and bills payable account. You prepare the creditors account, bills payable account. This is creditors account, this is bills payable. Again, you start from the first. You start from the first. In the opening balance, creditors is there. Buy balance brought down, creditor is 40,000. Okay, 40,000. Next is By bills payable. Bills payable opening balance is 15,000. By balance brought down. Then come to the cash book. In the cash book, by creditor is 70,000. So in the creditor account, to bank 70,000. To bank 70,000. Next item in the cash book is bills payable. In the bills payable account, you write to bank. To bank 30,000. Okay. Cash book completed. Come to the adjustment. Closing balances are there. First point. So creditors account to balance carried down. Closing balance is 15,000. In the bills payable account, closing balance to balance carried down. Closing balance is 10,000. Balance is completed. Then there is no other items. No other items. Problem completed. So close the account. Bills payable account total 40,000 debit side. Total 40,000 debit side. Difference 25,000. Difference 25,000. You take to the creditors account. In the creditors account, to bills payable account. Clear? You close the creditor account. Creditor account total is 1,10,000. 1,10,000. Difference 70,000. This difference is called as credit purchase. This is credit purchase. Clear? Now you close the debtors account, debtors related accounts. First you close the bills receivable. Total 40,000. Credit side. Total 40,000. Difference 20,000. Important item, debtors. Two debtors. In the debtors, buy bills receivable. It is buy bills receivable. Okay. Then close the bills debtors account. Debtors account total 1,50,000. 1,50,000. Difference 1 lakh. This 1 lakh is called as credit sale. Credit sale. Now I'll close the statement of phase. You close statement of phase. So statement of phase total is 1,60,000. 1,60,000. Difference 1 lakh. Difference 1 lakh. This is called as capital. This capital is related with first person, I think Santosh. It is the capital of Santosh. Remember this. Okay. Accounts completed. Now I prepare the trading profit and loss account. Trading profit and loss account. Okay. First item in the trading account is to opening stock. You take from the opening statement of phase 30,000. Second item, to purchases. You take purchase from the creditor account. Credit purchase. Cash purchase is not in the cash book. Okay. Then you take the trading account expenses from the cash book. In the cash book, there is a wages. Two wages. 20,000. Debit side completed, you go to credit side. Buy sales. You take cash sale from the cash book, credit sale from the debtors account. Credit sale from the debtors account is 1 lakh. Cash sale in the cash book is 15,000. Cash sale in the cash book is 15,000. Okay. Now total is 1,15,000. In this total, you remember you have to deduct the sales return. Okay. You remember the format. Less sales return 5,000. Remaining amount is 1,10,000. Okay. Then take the closing stock. Closing stock is 40,000. Closing stock 40,000. Now you close the account. Then The difference is gross profit. Difference is gross profit 30,000. Take the gross profit to the next part, 30,000. Next, you take the P&L account expenses. First, you see the cash book. In the cash book, first salary is there. Two salary is there. You write the salary, that is 15,000. Salary 15,000. Salary is 15,000. Next is general expense. You write general expense. You take general tax and general expense inner column. In the inner column, you take the general expense amount is 10,000. General expense 10,000. General expense 10,000. You deduct the outstanding of the last year. You deduct outstanding which is given in the statement of his opening statement of his outstanding expense is there. Okay, expense due. So you deduct that. That is last year. Then current year outstanding you have to add. But current year outstanding is no. There is no outstanding for the current year. Therefore, you deduct 5,000. Balance is 5,000. This is general expense. Then you come to the cash book is completed. In the debtors account, there are certain items. You have to take them. That is bad debt. Another is discount. Two items from there. Then in the adjustment, there is a depreciation 10% on furniture. Okay, furniture 10%. So bad debt is 2,000. Discount is 3,000. Then next is depreciation on furniture. Furniture value is furniture purchased for 18,000 and depreciation is 10%. On 18,000, 10% you make and you have to consider the period. Period is 1/7. So 1/7 to 31st March you have to see, not December 31st. Year ends on 31st March 1997. Up to 1997 March you have to count. Therefore, July, August, September, October, November, December, January, February. 9 months depreciation you have to charge. Okay, remember this. So 9 months depreciation is 1,350. You calculate 18,000 into 10 divided by 100. 18,000 into 10 divided by 100 into 9 by 12. 9 by 12. It is 1,350. I have not calculated. You calculate it. Remember this. Okay. Furniture is 18,000. 18,000 into 9 divided by 12 into 10 by 100. It is 1,350 or not. You check. Okay. This is the depreciation. Then you take the total. Total is 30,000. Difference is 3,650. 3,650 is the net profit. This is to be shared between the two, Santosh and Vikram. So first partner, Santosh, 3,650 into 2 by 3. Second one, 3,650 into 1 by 3 is the calculation. In this way, you have to calculate. Okay. First, you write as Santosh. By confusion, I had taken the A. That is not A. That is yes, Santosh. Remember this. Okay, this is the profit calculation. Now you see the balance sheet. In the balance sheet, first you take the capital. In the capital, first person is, he is the Santosh, not Anand. Santosh capital you take first. Santosh capital you take first. Then add net profit. His share of profit is 2,433. Take the total 1,02,433 less drawing in the cash book. Less drawing from the cash book. Drawing is 14,000. You deduct this, remaining is the capital of Santosh, 88,433. In the same way, Vikram capital is 40,000 from the cash book. Add net profit 1,217. Then less drawing is 13,000. His drawing 13,000 you deduct. Balance is 28,217. Then next check creditor closing balance from the creditors account. Bills payable account, closing balance from the bills payable account. Bank overdraft from the cash book. Bank overdraft. In the cash book, overdraft is there. Therefore, you take from the cash book, that is 10,000. Then there is no outstanding expense. It is incompleted. Come to the asset side. Asset side first is debtors. You take 30,000. Okay, bad debt I adjusted in the P&L account and debtors account. You remember this. Then next is bills receivable from bills receivable account. Then stock from the closing stock trading account. Furniture you take inner column 18,000. Less depreciation 1,350 as already deducted in the P&L account. Balance is 16,650. Then land and building you take as it is. There is no adjustment. And the problem completed, you take the total. Total is 1,51,650. Okay, this is the solution. Okay, this is enough for today. Today is Sunday. You enjoy. Tomorrow again I will take at 9:10. One more thing, remember. You remember one more thing, that is in the example number, exercise number 3, I have not mentioned the profit. Profit is wrong. Okay, only 500 something is there. Profit in the P&L account is 32,000. Yesterday someone called me and told regarding the mistake. By oversight, I have not recorded the profit there. Remember this.